Hello everyone. Today we'll be discussing different types of risk. Already we have understood what is the meaning of risk. Risk is a possibility of having an event which is not good for us, which is creating a lot of damage for us. So we have also discussed about systematic and unsystematic risk. And further, in today's video, we are going to discuss different types of risk. So, when we think about different types of risk, we are going to discuss all these types of risk on the basis of financial activities. When we are going to do different types of financial activities, it can be by the organization or by as an individual. When we are doing any kind of a activity, there can be number of risk involved, and those are the risk on the basis of financial activities. They are divided into four types, that is market risk, credit risk, operational risk, and liquidity risk. So we are going to discuss all these types of risk in detail. So let us move with the first type of risk, that is market risk. What is market risk? Market risk is a risk which results in a changes in company's portfolio with the ups and downs of the market. So here what happens is basically company's portfolio will change, and you can also find there is lot of ups and downs in the market. And when we are saying it is lot of ups and downs in the market, you can understand it is a macro level activity, so it is impacting the whole economy. So this is also a kind of a systematic risk. So basically market risk will happen because of changes in price. So this is also called as price risk also. And here price, in the sense, it is not directly related to price. The changes can be because of interest rate changes, or any risk involved in interest rate, or because of changes in fluctuations in exchange rate. And exchange rate changes also may lead to some kind of a market risk. So basically it is huge level changes which is uh, of one type of a systematic risk. So when we are discussing more about market risk can be divided into again five types. That is equity risk, interest rate risk, currency risk, commodity risk, and equity index risk. So let us discuss each type of risk one by one. First one is equity risk. What is equity risk? So think that there is any risk associated with changes in the price of the security which are traded in the stock exchange. The price of the stocks of different companies which are keeps on changing, and there are a lot of uncertainties related to one particular organization or related to number of companies. There is lot of uncertainties, so that is a kind of a equity risk. So equity risk is computed by ascertaining the standard deviation of the value of securities over a specific period of time. So this is a calculation related to equity risk. Basically, what is the meaning of equity risk? It is because of huge changes in the price of the security, which risk, what kind of a risk may occur, that is known as equity risk. The second type is interest rate risk. So, what is interest rate risk? With the changes in interest rate, the profit and loss may directly get impacted. Think that the interest rates are keeps on changing. Interest rates, and it will impact the company. Think that company has taken the loan, or company is going to deposit certain amount of money, or in different ways the changes in interest rate directly it will impact the company, and there can be changes in their profit and loss account. So sometimes think that they have taken a loan, and loan may become more expensive because of changes in interest rate, or think that they have done some investment and that investments are not giving the expected return. So that is basically because of interest rate risk. Third type, currency risk. What is this currency risk? Changes in exchange rate, change in the exchange rate that also can impact the profitability of the company. So think that the company is dealing with importing, exporting of goods and services, or it is dealing with other foreign companies where there need to be foreign exchange. So if there is huge changes in currency, or exchange rates are keeps on fluctuating, then there is a chance that the company may get lesser amount of payment than expected because of changes in the exchange rate, or because of changes in exchange rate company is supposed to pay more amount than expected amount. So these are the risk because of currency changes. So this is known as currency risk. Next one is commodity risk. So commodity trading companies also face the risk of commodity price fluctuation. So when they are dealing with commodities, so think that there is a lot of fluctuations in the price, and that will also create a kind of a risk. So any adverse fluctuation, think that you are expecting profitability and it is something opposite, then it will impact the profitability. So any adverse fluctuations will impact the profitability, and this is known as commodity risk. Next one is the last type in market risk is equity index risk. So what is this equity index risk? It is basically related to changes in the index price. So because of lot of changes in the index price, if there is any loss, then it is known as equity index risk. So this is all about market risk. We have discussed the five types of risk under market risk. We are moving to the second main type of risk, that is credit risk. What is the meaning of credit risk? Credit risk is a type of risk where think that your counterparty is not making the payment. Okay, it is a loss which occurs when the counterparty involved in the trade or a contract does not honor it or does not make a payment. Think that you have given certain amount to one particular uh, party and they are not returning it, means it is a bad debt for you. It is a huge amount of loss. So any loss to a company, or when there is an agreement, if counterparty is not making the right payment, then because of that what risk is faced, that is known as credit risk. So what will happen when there is credit risk? Because of credit risk, there will be huge amount of losses, and when any party is not able to pay the money or not making the payment, means here in that case the liability of the where the loss is more, the number of the amount of bad debts will keep on increasing. So to give an example, think that a buyer of a security of the seller is not making the payment, or uh, any loan taken from an financial organization, financial industry, and that money is not paid back. So think about a company which are involved in manufacturing and trading, and if the payment is not done, because of that what risk they can face, that is also known as credit risk. So when credit risk take place, or when there is non-payment of the loan amount, it will impact the company's performance. So if you think about bank, if there is high credit risk, or any institution, if there is high credit risk, then that will result in high non-performing asset. So what is non-performing asset? Non-performing asset in the sense thing that a certain amount what you're supposed to receive and you're not receiving that money, and at the same time you cannot utilize it. For example, think that in your balance sheet you will have debtors. What is the meaning of debtors? From them you're supposed to receive the money, and when you're not receiving the money, though it is an asset, it is a kind of a non-performing asset, which is also uh, creates problems to you, and which is not giving any return. So when we are further discussing about credit risk, even credit risk can be classified into three types. That is transaction risk, concentration risk, and measurement of credit risk. So let us understand more about transaction risk. So transaction risk comes into place when the organization is affected by changes in the cash flow due to exchange rate. So here, think that you are supposed to receive certain amount of money, and there was a exchange rate changes, and because of that exchange rate changes, you are receiving the less amount of money. So that is when happening when there is transaction is happening, you are not receiving the money because of changes in the exchange rate. So uh, the longer time period, the higher exposure to transaction risk. In case of firm which are operating in different countries, the transaction risk is more prominent. Why? Why? Because there will be changes in the exchange rate. Moving to the second type, that is concentration risk. What is concentration risk? This risk pertains to the overall exposure to a firm, exposure of a firm, and where it is concentrated at. So, to give an example, think that firm trades more on equity sector, equities of power sector. Okay, a firm is trades more on equities of power sector, and uh, power sector is impacted, and because of that, there is the concentration was given to one particular sector and that got impacted. So that is known as concentration risk. And the last type is measurement of credit risk. Uh, it is how to calculate the credit risk. So, credit risk, to calculate the credit risk, so we need to know what is the exposure to credit it is given, and at the same time, what is the possibility that the borrower may not pay the funds. And to assess this, it is not easy. So, what is the exposure to credit? At least we can try to estimate, but what is the possibility that the borrower is not paying is quite difficult to measure, and that is also because of that. When we are not able to measure, there can be it may lead to risk. Moving to the third main type of risk, that is operational risk. So, operational risk refers to the risk from carrying out the operation of an organization. So, how you're carrying out your activities, depending upon that, if there is any risk arised, then it is known as operational risk. So, this risk can be basically related to one particular specific organizations. Uh, so, when we are discussing about operational risk, you can think about functioning of the organization. So, the risk arised out of malfunctioning of its processes or systems. So that is known as operational risk. So what can be the different types of risk involved here, or what can be the different instance which we can consider is one is failure of system as in technical know-how, or not maintaining the documents properly, or using improper documents, or errors in operation and incompetent management, not doing the not able to manage all the work, or fraudulent activities, and at the same time breach of client data or confidentiality. So because of that, what can be the risk which can be erased, that is known as operational risk. And the last type of risk is liquidity risk. So liquidity risk occurs when the asset is not liquid or which cannot be sold. uh, think that because of certain activities you are not able to convert your asset into liquid form, you cannot sell it, then uh, there's no use of having that particular asset. Rather than it creates than having that asset, it creates certain kind of expenses. So liquidity risk refers to the probability that the asset of the company may not remain liquid, thereby affecting it and in some cases making it insolvent. What will happen in this case? Think that you're not able to convert your assets into liquid form. You cannot sell it, you cannot use it, you cannot convert into cash form. Then uh, it is waste of having that asset. That means it creates unexpected payments, and because of that, what can be the risk erased? That is known as liquidity risk. And when you're not able to convert, or your liquidity ratio is less, that means it gives an indication saying that your company or your organization is not performing well. So these are certain types of risk which are uh, related to financial activities, and how to avoid that risk. We need to assess the risk properly, and accordingly risk management activities risk management need to be done, and necessary measures need to be taken. Thank you.